Hello and welcome to everybody who joined today's webinar. Thank you for joining. My name's Carl Brooks. I'm the Partner Account Manager at Prospend, and I'm happy to be joined by Nunzio Ginter, Managing Partner at Ginterbell. So the reason for this webinar is we have partnered with Ginterbell and Ginterbell offer Prospend to their customers. And likewise with our customers, we would like to bring you the best of breed in terms of solutions that are available and also partners that we work with in terms of meeting your needs. So this webinar is designed for those people that are using accounting software and may have outgrown it, and for those businesses that work exclusively in the NFP and charity space. So let me introduce Nunzio to you. Nunzio is the managing partner of Ginterbell, a CPA public practice that works exclusively with those NFPs and charity organisations. Nunzio has a number of other commitments. He is the chair of the CPA Queensland for Not-for-Profit Committee. He's also a member of the ATO Not-for-Profit Stewardship Group, and he's also a member of the AASB Not-for-Profit Project Advisory Panel. So as you can see, Nunzio brings a great wealth of NFP knowledge to this webinar. Also, he has won awards. He's won Not-for-Profit Accountants of the Year in the Accountants Daily Australian Accounting Awards, and that was in 2021. So welcome, Nunzio. Great to have you on board. I'll hand over to yourself to go through the agenda and the rest of the webinar.
Thanks, Carl, for the introduction. Yeah, it's a pleasure to be here today. We've got a fantastic relationship with Prospend and really enjoy doing these webinars and really to sort of add value to the NFP and charity community. And one of the things, Carl, we've talked about is around finance systems and making sure that finance teams in the NFP sector have fit for purpose finance systems where they really can get the most out of those systems to support their organisations. So they can actually work towards achieving the right outcomes for those charity organisations. And one of the things we really want to sort of talk about today is around how do we look at making sure that we've got the right systems today, but also the right finance systems that will then take us into the future. And one of the things I'll be really focusing today around is looking at exploring what are those key pain points that finance teams in the NFP sector experience, and sort of work through those, then work through, well, how can potentially we solve those through getting the right finance systems or best of breed systems. And in terms of a bit of the agenda today, broken up into a number of areas. And one of the key areas I see a lot of pain points relates to revenue recognition. Revenue recognition in the NFP sector is quite complex and creates a lot of friction when it comes to end of month close for finance teams. So I'll unpack that through a couple of examples and talk about best of breed systems that potentially can solve those issues. The other area I'll talk about is cost allocation. It's around how do we allocate overhead cost or corporate costs from one area to other areas of the business, such as grants for acquittal purposes, and talk about the complexities, but also how do we automate that through the right finance systems. If you talk to any finance team, in particular NFP sector, credit card, debit cards, always a major pain point and source of frustration. What can we do in terms of implementing the right finance systems to overcome that issue or streamline that issue? In terms of NFP sector, one of the key things is around stakeholders. Finance teams are reporting to multiple different stakeholders, and that creates a lot of friction around having this being able to actually have the information at your fingertips to then publish to those different stakeholders, and I'll unpack that. Then finally, I'll talk about if you're looking at uplifting your finance system or systems, what's the go-to-market strategy? What does that look like? I'll first talk about revenue recognition. This is one of my favourite subjects in the NFP sector, and that's because of the complexities around it. And I see a lot of challenges faced by NFP organisation, in particular finance teams. And it stems from changes that has happened over the last few years. The key changes that took place was the introduction of new accounting standards. So we had AASB 15, revenue from contracts with customers, AASB 1058, income for not-for-profit entities. And these two new accounting standards with mandatory adoption from 1st of January 2019. Now, the best way to highlight the complexities that these standards bring is actually through an example. So if take you through this example, let's say on the 1st July 2023, a new charity commences. So that is the new registration. It's a brand new entity. And let's say for the 23-24 financial year, this new organisation has been awarded a funding contract of $720,000 ex-GST. On the 1st of July, this new organisation receives $250,000 into its bank account as its first instalment. And let's say during that month of July, $48,000 is expended in terms of acquitting against that $250,000 that we received. Let's assume that we received spent that full $48,000. The other thing, I just want to ignore GST. So we've just thrown up a bit of a poll for you in terms of what we need to recognise for revenue. So if I can get you just to go through that poll and what you think. So the options for the poll is, do we recognise $720,000, $250,000, $48,000? I don't know, or I need more information. So I'll give you about a minute to complete that. Okay, so in terms of there's in terms of the results, there is a bit of confusion around potentially what it could be, and what I'll talk through is around what are the options when it comes to revenue recognition, and so we've got a number of different key ways we can recognise that revenue, and so if you look at option A, we talk about being the received methodology, and that's potentially where we recognise what we received in the month of July. So if you look at the example, we had $250,000 which we received, and therefore we're recognising income of $250,000. We've expended $48,000, which gives us a total net profit of $202,000. In terms of our balance sheet results, we've got $202,000 in the bank, which represents the $250,000 received less the $48,000, which gives us a total equity position of $202,000. So that's what we call the received sort of method. Then we've got another option. So option B, and typically I refer this as being the 1/12 method. And this is where what we've recognised is 1/12 of the total funding contract over those 12-month period. So what we've done is recognised $60,000 being revenue. In terms of expenses, we've recognised $48,000, which then gives us a net profit of $12,000. Cash at back doesn't change, but now you'll see we've got a prepaid income of $190,000 and net asset of $12,000. So quite same scenario, but quite different result in terms of the financials. Then we've got another methodology, which option C, which is I refer to as being the expense method. And I see this quite common, and this is where the organisation makes a determination that in terms of its acquittal of the grant or the funding, they use expense as a measure of that acquittal. And therefore, based on the $48,000 that's been spent, we then recognise $48,000 as being income. That means the net profit or surplus is zero. Cash at bank is the same, but this time we've got a prepaid income of $202,000. So you can see very different results based on the different methodologies that are used. So my question is well, which is the method should be used to comply with the accounting standards? And it depends. And this is really where the challenge lies in terms of managing revenue recognition. And under the accounting standards, you actually need to go through a 5-step process. You need to look at each individual contract. You need to look at whether that contract is with a customer and whether it's enforceable as a first step. Step 2, you then need to identify the separate performance obligations in the contract. What does the contract say you need to deliver? Now, in the example, I didn't disclose that. So as a finance team, you need to pick up the contract, you need to look into it, and you need to understand what do we actually need to do to deliver in terms of the contract. Then you need to determine the transaction price. In this example, we had the transaction price as being the full grant amount. And then what we need to do is allocate that transaction price to each of the performance obligations. So depending on what we're delivering, then we need to determine the elements associated with each of those components. And then we need to recognise the revenue as we satisfy each of the performance obligations. And that's the steps that we need to go through. And so what is the implications to the end of month close and financial reporting? The implications are that it gets complex. You actually need to look at each individual funding contract, work through those 5 steps, and then that drives the revenue recognition. It's with the new standards, it's not just about developing a policy across all revenue. You actually need to look at each of the individual contracts. So what does that mean? If you look at donations, for example, a donation, may be money that you've received and there's no enforceable contract there. And therefore, potentially you need to recognise the revenue, all of it, when you receive it. The other implication is multi-year grants. If you have a multi-year grant, how do we recognise that revenue over multiple periods versus a one-off grant, if it's for a 12-month period, for example. And the other one is membership and subscriptions. Typically, membership subscriptions, if they're 12 months, you then need to recognise that revenue on a 1/12 basis and track that. So just means there's a lot of complexities around tracking revenue across your different funding streams. So what do I see happening? I see that a lot of these calculations are actually not held within the finance systems. Finance teams are maintaining these complex schedules outside the finance systems and typically using Excel to maintain the calculations. What I see is inconsistent application. I see that some finance team really struggle around being consistent and being consistent from year to year. As the teams change, then people come in there and they don't have the records there to provide the substantiation around what for that grant, how do we need to recognise the revenue. I see it tying up the team, finance team, in maintaining those revenue recognition schedules. It's a lot of work, and it's literally taking days for someone in the finance team to maintain that on a monthly basis. The other area is a lack of substantiation and audit trails to meet audit requirements, and it is a key frustration for auditors. Auditors end up spending a lot of time on these schedules and to actually really provide, have the evidence to support their audit findings. And it's definitely a key of that slows down the audit process. So how do we solve this? In terms of solving this, ideally you'd say that the standard setters would help in terms of streamlining some of these standards, but that's a longer process. One of the key things as a finance team is to make sure you have the finance systems that can help automate a huge amount of these complexities. And starting with having one central source of truth, having one place within your finance system that captures each of the funding streams. And once you then capture the funding contract, the variations, you then want to be capturing within the finance system things like the invoicing milestones, acquittal dates. How many times does a finance team get less than 24 hours notice that an acquittal report needs to be done? So having that information so the finance team can be proactive instead of reactive is really important. Making sure that the finance systems have the revenue recognition rules apply to each of the contracts, so you have visibility of that. The other one is the automatic tracking of the revenue recognised for each period over the life of the contract, so you can see the audit trail associated with that. The other one is the automatic tracking of prepaid revenue balance for each funding contract, which is really important. And then the automatic creation of accounting general journals for each period. So therefore, it's automated. You're not doing manual entries. And as I mentioned, really important, full audit trail. So you're keeping the auditors happy, and then moving on to more value adds as part of the audit process. And so that's really, my advice to you. If your finance systems aren't providing you with this is looking at when you go to market for a new finance system, and you identify this as a problem, then that's one of the key things you need to look at in terms of your finance system. This is just an example of one of the finance systems that we deal with, Sage Intacct. And this is where it has a revenue recognition template associated with each of the funding contracts. And what we're able to do is just quickly determine what's the recognition method. Is it straight line? Is it percentage complete? Is it based on milestones? And then we're able to track that through the finance system and provide that information to the auditors. Next item I'd like to talk about today is around cost allocations. This is, again, another pain point we see and an area of complexities. And typically what the concept of cost allocation is, where you're allocating shared costs, for example, corporate services costs, to 2 or more areas. And you might be allocating them to different cost centres, different departments, different programs, and really important to grants. If you have a grant, you need to be able to allocate some of those overheads from corporate services to those grants for acquittal purposes. And that becomes really important to do that and having the methodology around it. So cost allocations is definitely, especially in the NFP sector, is an important part of that end-of-month close and budgeting and planning. So why use allocations? It's about the true cost. We want to make sure that we're allocating true cost to the different programs that we deliver. And so therefore we can then provide the right information to our key stakeholders to say that the cost of delivering this grant is X. And the other thing is also to create sustainability. If you have a grant that you've applied for and you're not allocating overheads, as you get more and more grants, your overheads will grow and you're not then recouping that from the grant. So that's why allocations is important. So in terms of types of allocations, you typically got the conventional overhead costs that you allocate. Your infrastructure costs that you can allocate. Staffing costs. In some cases, you'll have shared staffing that needs to be allocated to specific areas. Another really common is IT costs. In many cases, IT costs are pooled. You'll have software, you'll have infrastructure, and then that needs to be allocated across to different grants or programs or departments. Rent's another one. You may have 3 programs running out of one building. How do you allocate that rent? Another one I see happening also is marketing and fundraising in terms of allocations. So in terms of allocations, I see in my travels in working with finance teams, I see 3 main methods of allocations. And the first one is at the time of transaction. So the time of transaction means is when the finance team receives a tax invoice and they process it in the finance system, they then allocate at that point to the different department areas or different grant areas. And that's done typically around preset rules, and it's based on a fixed amount. So for example, let's say we receive a tax invoice for $6,000 for IT costs. And what we've decided is that the IT costs will be spread over based on a certain rule, which is 50% to grant A, 25% to grant B, and 25% to grant C. So that's done at the point of data entry and allocated and processed. Very common to see it on a regular basis. The other methodology, which is a bit more complex, is where there's a policy that the allocation is computed not when you're recording the transaction, but after. And that's because you don't actually know. There's some variables that you don't know that will then drive that allocation. So you only know that variable at the end of the month. And some examples of that is you could be basing that allocation on FTE or headcount. And I see this really common with IT expenses, for example. The allocation happens based on the headcount that are using that are consuming those resources. And you only know that final headcount at the end of the month. So when you're recording the transaction, you can't do the allocation. You have to wait at the end to do the allocation. Another I see very common is the allocation based on revenue. So we do the allocation from a revenue perspective. The other one is when it's based on, for example, square meterage. and you may, in terms of that example of rent, you work out the square meterage and then you do that allocation. So that's all driven post. And the final method I see is, I suppose, what we call fixed. And fixed is where we allocate the expense, on a predetermined amount. It's usually set when we do the budget build, and then we just allocate that on a monthly basis based on what we've decided. And typically, you then tweak it slightly throughout the year, either every 6 months or at the end, and that's typically sort of the approach. So, in terms of these allocations, I typically see most organisations, particularly large organisations, use at least one, if not a hybrid of all three. And I definitely see across where some organisation will actually use all three methodologies. So, what's the implication in terms of finance systems? The implication is that, if you think about at time of purchase, the requirement to then look at that transaction and then each time start to work on the different rules around splits, it slows down data entry. And so having a finance system whereby there knows there's a rule in place and does the automatic application based on the template rule, then speeds up that whole data entry. So that's what really you need to look for, is a finance system that automates that process. In terms of after the purchase, or that dynamic allocation, where it's determined around things like FTE or square meterage, having a finance system that captures that statistical information, such as headcount, FTE, square meterage, then enables the ability to allocate those expenditures, such as corporate costs, to a certain department area, and then using the rules creates an automatic allocation based on, for example, the headcount or FTE, and automates a general journal for each month. The other thing is that having a finance system that maintains a full audit trail. I'm aware of some grant acquittals that need to be audited, and what the auditors want to see is, well, how did you calculate the overhead allocation across to that grant? Provide me with the evidence so then I can sign off on it, which is really critical. The other one is ability to, in terms of fixed, you really want a system that will then do an automatic general journal entry at the end of each month to sort of capture that amount. So, Carl, I'm not sure whether there's a poll too for this one in terms of organisations, what they're using.
I've just launched it for everybody.
Okay. All right. The next area I'd like to talk about is around, sorry, Carl, do you have the results for that poll?
I've just shared them with the audience.
Okay, fantastic. All right, thank you. The next item I'd like to talk about is, definitely, I know from finance teams is a key pain point, and that's credit card, debit card reconciliations, or just dealing with credit cards in general. Any organisation that has credit cards that are used outside the finance team, it can be a real challenge. And the question I pose is, well, why is it so hard? And the reason it's so hard is that we find that a lot of cards are actually shared. And so, the finance team's responsibility is to make sure that we've allocated the transactions to the appropriate accounts, the appropriate departments, and because the auditors will eventually look at that and ask questions. And so when cards are shared, it's actually then hard to identify if there's missing information, who's responsible for that, who actually spent those funds, and therefore it creates a lot of challenges and really difficulties around the end of month close. The other one is around paper receipts. A lot of times credit cards, they're paper receipts, and then there's a delay in receiving it. Keep in mind that credit cards typically, they are mobile. Their staff are using them while they're out and about. They get a receipt, they lose them, or there's just a delay in getting them. Finance teams are looking at closing the end of month by 3-4 days. it doesn't help when you get the receipts on day 11. It just slows down the entire process. The other key area is around the types of cards. There's corporate credit cards, there's fuel cards, there's debit cards. It's all coming from multiple sources, and therefore reconciling it, bringing it all together can be really challenging because there's the data is flying in through those different multiple sources. Other major pain point, is dealing with the banks. I know I've first-hand experienced the frustrations of when dealing with credit cards, dealing with banks. It's hard to change limits. It's hard to cancel or issue it to a new staff member. It just creates all sorts of issues. How many times a new staff member starts and it takes 90 days for them to get their credit card. So it creates a lot of challenge. The other key challenge for the finance team is manual data entry into the finance system. So a lot of this is all data's being captured, the receipts get sent out, and then it's the finance team's role to then key it into the finance system. So that creates a lot of challenges and a lot of friction. The other one is risk of fraud. In many cases, the finance team doesn't have visibility of the transactions until from maybe 20 days down the track, and therefore need to investigate. This $20 is this fraud, and it sort of consumes a lot of the finance team's time. The other one is another source of frustration is subscriptions. How many of us have seen a subscription that's been hitting the credit card for the last 4 years, and we ask the question, "What's this?" and no one can provide us an explanation, and therefore it starts to consume a lot of time tracking it down and then trying to cancel it, and then it just could sit there for forever in terms before you cancel it. So they're sort of the key frustrations we see, and I know I've experienced firsthand. So in terms of then, how do we solve for this problem? And one of the exciting things, and I suppose one of the key areas in terms of our relationship with ProSpend is this whole concept of virtual cards, but also the whole concept of being able to manage credit card, debit cards, virtual cards, all in one place. And so what does this do? What it enables you to do as a finance team is ensure that one card is per user. Because it's so easy to spin off a new card, with a budget limit, you're able to issue it to whoever needs it when they need it. And therefore, there's less likelihood that someone else will use or share cards. It's such and it creates accountability around that card. The other one that we see with a number of customers that will issue temporary cards. So let's say they've got directors that are having a strategic planning session, they're traveling. The ability to issue a temporary card for them to use just creates some improvements around that, and therefore you're not collecting paper receipts. The other one is around the ability to actually take photos of the receipts on the phone, and the ability to actually code it while they're actually taking those receipts. So it's a really powerful mode to be able to capture that information instantly. As I mentioned, all the corporate credit cards, fuel cards, debit cards, all can be all channeled into one place and have that one source of truth. My favorite, don't need to deal with banks. The finance team can have the authority to issue the cards to who they needed to, and have the ability to change limits and the ability to pause cards. So if one of the cards they feel is being misused, it can be paused for a period of time, and that actually creates a lot of control. The other one really important is the automate the data entry into the finance system. The ability for once the transactions are captured, for example, in ProSpend, and having them API back into the finance system with all the source documents, fairly instantly, is such a time saver for finance teams, and provides a high level of control. The other one is reduce risk of fraud, because the finance team is getting visibility of those transactions literally, daily. They then could quickly see if there's any issues and pause cards if there's any concerns. And finally, subscriptions. The ability, and we do this with ProSpend, whereby and our clients will actually issue individual virtual cards for each subscription. And so if there's one of the subscriptions they want to cancel, but we're having challenges cancelling it, we can just pause that card or cancel that one card without affecting all the other subscriptions. And really, really powerful feature to have. So in terms of the way the virtual card component works, it's if you've got a Apple Pay or Google Pay, you're able to load. You're given access to a card. That card then appears on your phone, and you're able then to use that to tap to pay for any transactions. Once you pay for a transaction, what you can do is then take through the app, take a photo of that receipt. Once you take a photo of that receipt, it will use OCR and scan that data automatically into the app and then pre-fill some information. You can then add additional information. For example, if you need to add information around what grant it belongs to or what project, you can then add that information in there at that point in time, or the finance team can add that at a later stage. So it really creates a lot of help, a lot of improvements in that space. So we just put a poll question for you. And the poll question is, would virtual cards benefit you with month-end close? I've got a yes and no answer. I'm not sure about you, Carl, but I know the answer personally to that question.
And those on the webinar agree with you.
Fantastic. So 100% are saying yes, and I totally agree with that. I think that's a leading question, wasn't it, Carl?
Yes.
The next topic I'd like to talk about today is that in relation to reporting to different stakeholders. And if you think about the NFP sector, probably the NFP sector and finance team has the most complexity, I think, when it comes to reporting to different stakeholders. You've got, for example, the board is a stakeholder. The audit and finance committee is a stakeholder. CEO is potentially a stakeholder. The executive team are different stakeholders. The auditor is a different stakeholder. The program, project, and grant managers are different stakeholders. The regulator, such as the ACNC or the ATO, is a different stakeholder. And then you've got your funders. So you've got government agencies, you've got charitable trusts, you've got donors that are all different stakeholders. And what happens in terms of the different stakeholders is that they all have different reporting requirements. They want information in different ways to support their decision making. So that really creates a lot of challenges for finance team because you're dealing with those different stakeholders. And so if you think about some examples when it comes to reporting to different stakeholders, one of the classic examples is around your management accounts versus general purpose financial reports. And so the management accounts, the accounts that you're providing to your executive team or potentially your board, and the general purpose financial reports are those that you need to prepare to comply with your regulatory requirements and the ACNC, for example. And so the general purpose financial reports must comply with those Australian accounting standards. And so must comply with things like the revenue recognition we just talked about, leasing standard, and also must incorporate all the year-end audit adjustments. However, what we find is that potentially those adjustments actually confuse the management accounts. And so the management team that are looking at information internally don't want to see those adjustments. They actually want to see the information that's important to them. And so they want to exclude those revenue recognition adjustments. They want to exclude the leasing and end-of-year audit adjustments. And this is a huge pain point for finance teams because finance teams under a lot of the conventional finance systems only can prepare for one audience. And then once they do those adjustments, they can't then pair that back within the finance system. They have to then export to Excel to manipulate the data to then provide that information. So really, when you think about if you're looking at uplifting your finance team and finance systems, one of the things you want to look at is a system that can cater for reporting for different stakeholders within the one system. And for example, having a system that has, I suppose, what are called multi-books or multi-ledgers enables you to then post information to those different ledgers. For example, we work with clients whereby we've established a book called, or a ledger called, end-of-year audit adjustments. So what happens is that we then make all those adjustments in terms of compliance with the accounting standards in that ledger. And so when we report to the auditors and prepare our audit financial statements, we do book stacking. We stack our management accounts with those adjustments and then be able to actually report in that way. However, when we're reporting internally, we then unstack and just report the management accounts to that relevant audience. It just gives us so much flexibility around being able to report without the need to export that data to Excel and manipulate, and potentially where errors can occur. So really important, if you look at uplifting your finance systems, is having a system that will actually cater for that functionality. Super powerful and gives you lots of flexibility. In terms of another example of reporting to different stakeholders, and this is potentially when you're reporting your management accounts internally versus reporting to funders, and this is where you've got a situation whereby you're doing grant acquittals, and as you know, as a finance team, if you're doing grant acquittals, those grant acquittals can be very different to the management reports. And the reason for that is that your natural chart of accounts potentially do not equal or match the funding contract budgets. Also, the other one is that acquittal reports potentially can be over multiple years, and so therefore creates these inconsistencies. And the other one is that I've seen where the board approved budget is potentially different to the funding contract budget, because the funding contract was over a 3-year period, and then they create some sort of differences around that. So in terms of solving for this, having a finance system that can actually cater for this scenario is really important. And so the example I've got here is on the left-hand side, we've got our natural chart of accounts. And the natural chart of accounts is broken up into employment expenses, other personnel, and office expenses. And then you've got your individual accounts underneath that. And so what we're pretty much doing is posting to those natural chart of accounts in terms of doing our internal reporting. But this organisation, they have got a grant, which is called the Save the Forest grant. And in terms of when this funding submission was put together, the funding manager didn't look at the natural chart of accounts, and they put a budget based on personnel expenses, which is wages and salaries, employee on costs and consultants, and then other expenses, which was catering, printing, and office expenses. And as you can see, there's not a match between the two. However, it's up to the finance team to then create a report that will then that fits what the funding contract says it needs to. And this is where I see a lot of finance teams that what they need to do is export the data to Excel and then manipulate and remap in order to then provide that report in Excel. So what does a really good finance system look like that solves this problem? It's a finance system that allows you to do mapping. So within the one place of the finance system, the ability to actually say, okay, we are now need to report this Save the Forest grant. I will now create a acquittal report within my finance system that creates mapping. And so what we can do is create this concept of what are called account groups or account sets. And in this case, we're saying wages and salaries equals wages and salaries. Pretty straightforward. But in terms of then employee on costs, what we're picking up and saying work cover and super need to be mapped to employee on costs. Staff catering needs to go to catering. Consultants need to go to consultants. And then printing needs to be mapped to printing. And stationery postage needs to be mapped to office and expense. And for this report set or acquittal report that we've created within the finance system, once we create the map, when it comes to day-to-day data entry, we don't have to think about it. We just allocate it to our normal chart of accounts. But then when it's ready to do an acquittal report, because there's mapping in place, we just need to create the report, and it will bring across the mapping instantly. And the beauty of this is that I see a lot of this acquittal reports being done by really senior finance people because of the risk of the mappings not being done properly. But once you invest in doing the mappings up front, you can actually then delegate this task to other staff within the less senior people or finance people, and then just do a review in terms of what that work's been done, because the mapping has been take place. Really, great opportunity to allocate resources in a right way within the finance team. The other example I see, and this is a real life example, in my role as CFO of a number of NFP organisations, the organisation goes through different phases of strategic planning, and so I've been in a situation whereby the board has done a weekend retreat, and the consultants come in and they've developed a brand new strategic plan, and as part of the strategic plan, they've made a decision that the board needs to operate at a higher level. And really what they want to do is they want to create 3 strategic pillars. In this example, social enterprise, disability, employment, NDIS. And they just want the finance team to report at these 3 strategic pillars. And so I've seen this put the finance team go into a spin, because what they've done is the conventional finance system has been designed to support the previous strategic plan or the previous reporting requirements. And therefore, to be able to report in a different way either means redoing the entire chart of accounts or redoing the finance system to cater for that, or exporting all the data in Excel and then manipulating that on a monthly basis to report to the board. It just drives so many inefficiencies and is prone to errors. So what does a good finance system look like and how it solves this problem? What a good finance system look like is the ability to then again create mappings. And so if we look at on the left-hand side, what we've got is this is the map. These are the program and project dimensions that we started off with. And this organisation has disability employment programs. So it's got 3 based on states. It's then got job grants, again, based on states. It's then got a number of services, which is travel NDIS, SLES NDIS, care plans NDIS, and it's got cleaning services, social enterprise, and a laundry services social enterprise. And that's historically what's been reported. And we still need to report on that. The internal management team still needs information at that level. But the board says, I just want to know at my 3 strategic pillars. And so having a finance system whereby you can actually break up the dimensions across and do mapping is critically important. So, for example, what we do is having a finance system that will then work out that disability employment, we have the DES program, the job grants, needs to get mapped to disability employment. We also then have our 3 NDIS programs that can be mapped to the NDIS or create an NDIS group. And then our 2 social enterprises mapped to the social enterprise group. And what it means is that we still internally, once we do that mapping, we then can report to our managers internally using the conventional program areas. But then when it comes to creating a board kit, we can uplift that and report at those dimension groups instantly without any manual manipulation of data. And that creates a lot of power and a lot of flexibility. And also what we find is that finance teams are a lot more open then to starting to provide information on how stakeholders want to see it, because it's really easy to do. And it really creates a lot of innovation within the finance team to support that. A lot of times it's the restriction of the finance system that then creates a friction in relation to doing that. Other areas that I see creates a lot of complexities in terms of reporting to stakeholders is if an organisation has an auspice. And an auspice is typically where a larger organisation is managing the finances of a smaller organisation or a joint venture between a number of NFPs. And in terms of an auspice, if you're managing an auspice, the auspice transactions should not be full part of your audited financial statements. So you should be extracting that out. And what we see is a lot of finance systems just can't cater for that, or they need to use two separate finance systems to manage that, which creates a lot of inefficiencies. Having the one finance system that allows you then to capture that and then report on that separately really creates a lot of efficiencies. Another one is consortium. If you enter, especially in the disability employment space, a lot of consortiums for the DES programs. True consortium funding should potentially be stripped from your financial statements, because you're typically collecting money on behalf of a member, and that same funds are just flowing through and being paid out to the consortium member, and therefore the revenue and expenditure should be excluded. You still need to track it, you still need to report on it, but potentially you need to exclude it. And having a system that allows you to automate that through potential books or multi-entities really sort of supports that in terms of what you need to do. So we've just got another poll just in terms of reporting to stakeholders. And so really a question around how are you managing the situation at the moment in terms of, are you exporting your data and manipulating it to report to different stakeholders? We've got a yes and no answer. How are we going with that poll, Carl?
Very well, thank you. I'll share the results now.
Okay. I know definitely in my experience there's been a lot of pain associated with this space, and in most organisations that I go into doing some form of Excel manipulation in terms of reporting to the different key stakeholders. Okay, the next item I'd like to talk about is just in terms of going to market for the finance systems. In terms of going to market for finance systems, what typically we see is that first and foremost, finance teams are constantly under resourced in the NFP sector. They've got a lot to do. They're dealing with end-of-month close, reporting to different stakeholders, dealing with the compliance, and especially this time of the year for many, we're dealing with the audits, and so typically they don't have the resources to actually go to market in terms of uplifting their finance systems. The other thing is around how often do you uplift some of your finance systems? And typically the finance team, some members may do it once in their career or twice in their career. So it's something new. And so one of the things is, it's really important to make sure that you allocate the appropriate resources in terms of when going to market finance systems. And some of the things you want to be really doing is assessing your organisational needs. Things like your general ledger and your chart of accounts. Do you need this concept of books? Will you benefit from that? Will you benefit from having multiple dimensions instead of having just one dimension, such as jobs or a class? Having multiple dimensions to be able to cover up the data, is that important? Accounts receivable, the ability to automate the accounts receivable process, the ability to automate revenue recognition. They're all the things you need to consider. AP and procurement, having the functionality for OCR to automate that, having virtual credit cards. That's something you need to consider as part of looking at uplifting your systems. Funding and grant management, the ability to have that source of truth for all your funding contracts. That's something you need to consider. Cash management. Are you automating your reconciliations? And how do you streamline that? So that's something you need to consider. Reporting different stakeholders. Who are those stakeholders? What do you need to report to? And then making sure that you've got the reporting functionality, such as dashboards, within your finance systems to be able to publish that as quickly as possible. Another area is budgeting and forecasting. Have you got a system that and I see many organisations typically using Excel, and they want to get more people involved in the budget build process, but they can't because of the restrictions of Excel. Do they have a budgeting and planning and forecasting solution that will actually support collaboration in terms of budget builds? Fixed assets, what do you need? Is it just depreciation? Is it more than that? And so unpacking that's really important. Other one is data security and making sure as an NFP that is it on where is the data stored, making sure it's data stored and controlled within Australia, and also things like integrations. In terms of finance, we talk about finance systems, and the reason systems is that it's an ecosystem of best of breed systems that need to work together through integrations to get really the ultimate outcome. And then also look at non-functional requirements. Now, who is the implementation partner? Are they the right partner? Do they understand the sector? How are they charging? Are they charging by the hour or by outcomes? And sort of unpacking that and making sure that you've got the right partner to actually support the digital transformation is really important. In terms of supporting that journey, at Juntabel, we've recognised it's a big challenge for finance teams in the not-for-profit sector to go through that journey. And identifying that, what we've developed is a downloadable tender pack made exclusively for NFP and charity organisations in Australia. And so what you're able to do is download that tender pack. And in terms of downloading that tender pack, you then get access to a number of all those potential system requirements that you need to look for. And it really asks you the question of whether you need that functionality or not. So you're able to actually build, I suppose, that whole functionality set. And through our experience, we've identified, almost all catch-all of potential benefits from systems that you can gain, and then see whether that's relevant to your organisation. And then also, what we've, as part of the tender pack, is the ability to have a whole suite that you can send out to vendors to get them to then, put in a formal submission to you. And really what we're saying is it's really provides a lot of value to then make sure you choose the right solution and the right vendor for you. In terms of this pack, I said it's free to download for if you are a registered NFP and charity organisation in Australia. And I said there's no branding. This is something that we really want you to utilise and our contribution back to the NFP and charity community in Australia. Okay, I think there's another poll. And so I suppose it's just around, are you planning to go to market to uplift your finance system over the next 12 months? Yeah, so I just, if you just can complete that, it'd be good just to capture that information. And now it's going to open up to questions. Does anyone have any questions or any queries at this stage?
Thanks, Nunzio, for today's presentation. I thought it was very, very informative, and I just want to really just cross-reference some key takeaways that I got out of this webinar today. So I'm glad that you talked about the bad practice of sharing credit cards within an organization and how you've unpicked the problems that this can cause a business. I think obviously with virtual cards is a great solution in terms of solving that problem. And I don't think anyone will argue with you about the difficulty of dealing with a bank when you can basically self-manage your own virtual credit cards yourself by changing limits, deactivating, freezing accounts, and setting new limits, and also controlling the spend through merchant code restrictions. Another key takeaway was I'm surprised at how many stakeholders an NFP or a charity organization needs to are responsible to reporting into. That was a bit of an eye-opener for me. And I thought you gave some great insights on revenue recognition and the steps required to help you choose the correct method for each of those contracts, and that helps with the end of month closing. So we do have a few questions coming through. The first question is actually from myself, and it's about virtual cards. And really, I just want to get a temperature check on how aware of the CFOs in not-for-profits aware of virtual cards and the benefits that they give.
Yeah, it's a really good question. It's improving. So there's still definitely, whenever I talk to finance teams and I talk about virtual cards, I would say that in lots of cases, they're not aware of the solution. In most cases, they're not using a solution like that. And they get very quickly excited about the potential of using virtual cards. And so I've kind of almost seen a number of finance team actually put pressure on the business not to use cards at all because of this problem. But as soon as we start to talk about virtual cards, they can actually see, oh wow, actually that is a win-win for everyone. So I think still there's a lot of gaps there in terms of CFOs understanding the power of virtual cards, but it's improving, and it's definitely I'm seeing more and more understanding in that space.
Yes, you talked about the mistakes of revenue recognition. The question we've got is, typically how long does that slow down the audit process?
It can quite significant. Well, it's a slowdown, but what the actual issue I have with it is that the auditors need to spend so much time on revenue recognition, and keep in mind that the audit fee is typically fixed. And so they're going to allocate a certain amount of time for the audit. And the more time they have to allocate to revenue recognition means the less time they allocate to other areas. It's one of those, the cost benefit around, if we're able to provide the information in a timely manner to the auditors and they're comfortable with that, they then look at other areas where they can add value in terms of the audit process.
Excellent. And that's pretty much it for the questions today, Nunzio. So I'd like to thank you for your time, some great insights into that, and also talking about that ecosystem of finance solutions that businesses need to now consider rather than thinking of a one platform strategy. It's more of an ecosystem strategy, a technology stack. And obviously, we're very happy to partner with you at ProSpend to help on the expenses, which we talked about, the accounts payable automation, which we talked about, and obviously the virtual cards. And I recommend any CFO that's unaware of the benefits that virtual cards can bring to reach out to us. We are leaders in this space, and we've got some great content to talk to you, and we've got a great solution to offer. So thank you again, Nunzio, and thank you to all those people who've joined today's webinar.
Thanks, Carl, and good luck with everyone in terms of any digital transformation projects out there.